With headlines out there at the moment, like the one we're going to refer to in this video from the Wall Street Journal saying, small businesses are slamming on the brakes because interest rates are going up. What does that actually mean to you as a business owner reading that article or watching this video? Well, there's two factors you need to consider when looking at your debt. The first thing is what we call interest cover. How many times does the profitability of your business cover the interest expense of the business? For example, if you've got an EBITDA, so earnings before interest, tax, depreciation, amortization, what is that number relative to your interest and finance cost of your business? If you've got an EBITDA of $50,000 a month and an interest cost of $5,000 a month, then you've got a cover of 10 times. That's a pretty safe place to be, as long as you can retain the consistency of the $50,000. So that's question number one. Should you be pumping the brakes relative to your interest cover? When does the bank get nervous? Well, it's really a personal thing as far as I'm concerned. Your bank will have particular restrictions around what EBITDA versus interest cover it needs to have. And it might be a coverage of 4, or it might be a coverage of 3, where your profitability needs to be 3 times greater than what your interest expense is. That will depend on your situation and your contract. But I'm asking you as a business owner, what makes you feel comfortable and what makes you feel uncomfortable when looking at those numbers firstly. The second element is what is the underlying impact on the debt position of your break even? Those debt repayments become part of your break even. They need to be factored into that calculation. And if the interest rates are going up, your loan repayments are going up at the same time. How does that impact your break even as a business? As we say, at a minimum, we strive for a 50% gap between what our break even is and what our actual sales are. For example, if my monthly break even is $300,000, we should be striving for monthly sales of $450,000 at least. Your contribution margin will be a big dictator as to how big that gap needs to be. But let's say for simplicity in this video, we're aiming for 50% gap as a minimum. How does your interest expense and your interest coverage compare? And what does your actual sales versus your break even compare? So you can get captured by these headlines, pumping on the brakes. But remember, during times of challenges in the economy, that's when great investments are often made because people are fearful. What are the deals that can be created? What are the bargains you can potentially buy that can catapult your business over the next 5-10 years? At the same time, being respectful to interest cover and your break even of your business, so you're not risking the farm, to use that cliche.